$52.57. That was Affirm's closing stock price just yesterday, May 16th, 2025. Now, thinking like Warren Buffett, with that value lens, the big question we're tackling today is Affirm a bargain right now? Or is it maybe
Yeah.
a bubble waiting to pop?
Yeah, that's the million-dollar question, isn't it? Especially in this whole buy now, pay later space. It's moving so fast, and Affirm is, a really big name in it.
Exactly. Affirm Holdings, that's ticker AFRM, they've definitely carved out a big slice for themselves. And their mission, it's all about honest and transparent financial products.
Right, and you really see that in their core promise, the whole no late fees, no surprises thing.
It is different, isn't it? Especially in finance.
It really is. And their model is, well, it's interesting. It's this two-sided network connecting shoppers and stores.
Yeah, consumers and merchants. And they've got quite a few ways they actually make money.
It's not just one thing. They get fees from the merchants, obviously.
Right, and interest from consumers on some loans. They make money selling loans, servicing them, and now even interchange fees with their Affirm card picking up steam.
So to really figure this out, we dove into a pretty detailed value investing analysis of Affirm. It was finished just yesterday, May 17th.
Our goal here is basically to pull out the most important stuff.
Yeah.
Separate what really drives the value from just the market noise.
Trying to get past the headlines and see what the company's fundamentally worth.
And we definitely found some interesting things, some real aha moments. We're going to talk about why that no late fees model is actually way more than just good marketing. We'll look at their AI platform, Adapt AI, and what that might mean. And we have to navigate the whole BNPL landscape, including some recent regulatory stuff you need to know about.
It's fascinating how it all connects. Like that no late fees promise, it completely changes how they have to think about credit risk. They can't rely on penalties.
Exactly. So the core question for this deep dive is, does that 52.57 share price actually reflect Affirm's intrinsic value, considering all the risks and, of course, the opportunities?
Okay, let's start by really understanding the business itself.
Sounds good.
So that mission, to deliver honest financial products that improve lives. It really does seem to drive their strategy. That no late fees, no surprises approach is a key differentiator.
It is. I mean, think about it. In finance, hidden fees are everywhere.
Right.
So this approach, it's about building trust, building loyalty for the long run, treat people fairly up front.
And that ties right back to their founding in 2012, Max Levchin, one of the co-founders.
The PayPal guy.
Exactly. His fintech background, his experience, bringing him in as CEO back in 2014, that was huge. It gave them instant credibility, especially on the tech side.
And look at the growth since then. Startup to IPO in January 21. The numbers are pretty staggering.
Yeah, by 2024, what was it? $28 billion in annual payment volume.
Yep, $28 billion.
Yeah.
And 21 million users, something like 337,000 merchants on board by 2024. And those big partnerships, like Walmart, and integrating with e-commerce platforms, plus acquisitions like Returnly, you can see how it all added up.
That growth is impressive, no doubt. But, once you go public, the game changes a bit. The focus shifts to actually making money, sustained profits.
Right.
So the fact they reported a net income in Q3 of their fiscal 2025, that's a really big deal. It signals maybe they're turning that corner. It's not just about growth anymore, it's profit from that growth.
Which leads us nicely into looking at the management team, starting with Levchin.
Yeah, his philosophy, that honest financial products idea, it's not just talk. Given the no late fees model, they have to be disciplined with underwriting.
They can't just make up losses with penalty fees like some others might.
Exactly. So his focus seems to be on building sustainable unit economics. Plus, he owns a lot of stock, right? So his interests are pretty well aligned with shareholders. He wins if the company creates long-term value.
And it's not just him. They've got a solid team around him. Michael Linford as COO, Rob O'Hare, the CFO.
Catherine Adkins covering legal and compliance, Libor Mikolek as president, Brooke Major-Reed handling capital, Vishal Kapoor on product.
Yeah.
They seem to have the key areas covered with experienced people.
Operations, finance, legal, capital markets, product. All crucial for a company like this.
And you look at their track record together, scaling the business, handling the IPO, innovating with things like the Affirm card and Adapt AI.
And hitting that GAAP profitability in Q3. That's a recent win for them.
Definitely. But the key now is sustaining it. That's what investors will be watching very closely.
Absolutely. Okay, so we understand the business model, the management. Let's dig into the numbers. The financial health.
All right. Looking back historically, the growth in gross merchandise volume, GMV, Basically, the total value of stuff bought using Affirm, it's been really strong.
Like really strong.
Yeah, it went from about $3.9 billion in Q2 of fiscal 22 up to $7.5 billion in Q2 of 24. And then the latest quarter, Q3 fiscal 25, it hit $8.6 billion.
Wow. And revenue followed that climb too, right? From what, $1.35 billion in FY22 up to $2.32 billion in FY24.
That's right. And Q3 FY25 alone brought in $783.1 million in revenue. It shows people are using Affirm more and more.
And it's not just the total dollars. The number of people using it, active consumers, jumped from around 12.7 million 2 years ago to almost 22 million now.
And they're using it more often, too. Transactions per active consumer went from 2.7 to 5.6 in that same time frame.
So more users using it more frequently. That sounds good.
It does. But we have to look at the other side, profitability historically. FY22, they lost over $700 million.
Ouch.
FY23 was worse, nearly $1 billion loss. It improved in FY24 to about a $518 million loss. But still, those are big numbers in the red.
Which is exactly why that little $2.8 million net income in Q3 FY25s stand out so much.
It's small, yeah, but it's a potential inflection point. Maybe the model can be consistently profitable.
Looking closer at FY24, and this recent Q3 gives us a clearer picture of where they are now. FY24, $2.32 billion revenue, $518 million loss, $28 billion GMV, 21 million users.
Got it.
And Q3 FY25 really showed momentum. GMV up 36% overall, strong growth in direct-to-consumer and the Affirm Card.
Active consumers up 21%, transactions per user up 20%, total revenue $783 million. And they broke that down too, right? Network revenue was $272.5 million.
And interest income was the bigger piece at $402.7 million.
Management also talked about RLTC revenue less transaction costs. They said trends were positive there. That's important because it shows if the core lending is getting healthier after costs.
Right, like the profit margin on the actual transactions.
Exactly. They also mentioned keeping operating expenses in check, narrowing the operating loss, which all led to that small net income and positive EPS.
Interesting, though, that the stock dipped after earnings, even with that positive news.
Yeah, sometimes the market just expects even more, expectations game.
So what about the balance sheet? How does that look as of end of March 2025?
Liquidity looks pretty solid. They had $2.1 billion in cash investments. Yeah. Plus, they mentioned $4.4 billion in funding capacity.
So access to more cash if needed, total assets around $10.5 billion.
Roughly, yeah. Against total liabilities of about $7.7 billion. And a big chunk of that is debt, around $7.5 billion total debt.
That sounds like a lot of debt compared to their equity. What was equity?
Stockholders' equity was about $2.79 billion. So yeah, the debt-to-equity ratio is, well, it's up there.
How are they structured, debt-wise?
It's pretty diverse. They use warehouse facilities, sort of short-term lines, to originate loans.
Before they package them up.
Right. Then they use forward flow agreements. They issue asset-backed securities, ABS, selling bundles of loans, plus convertible notes and a revolving credit line.
Okay, so different tools, but still that debt level.
Yeah.
Although you mentioned a high current ratio.
Yeah, likely because they hold a lot of loan assets on the books plus their cash. So short-term assets look good against short-term liabilities.
Got it. And cash flow. That's often a telling sign.
This is actually a really bright spot. Operating cash flow has been trending positive, hitting $786 million for the trailing 12 months.
Nice. And free cash flow after expenses.
Also positive, $613 million TTM. That's a significant development. They were actually FCF positive in every quarter of FY24.
Okay, generating their own cash internally. That gives them flexibility, reduces reliance on just borrowing more.
Huge plus. So we have a picture of the business, the team, the financials. How's the market feeling about all this right now?
Right. Market sentiment. Stocks at $52.57. Market cap around $17 billion. What are the analysts saying?
It's a mixed bag, really. Average price targets range from maybe $56 up to near $68.
Any recent calls?
Yeah, Morgan Stanley has a hold at $60. JP Morgan, buy at $69. BofA is bullish, buy at $80. UBS, hold at $56. Wells Fargo, buy at $67. So definitely some disagreement there.
Okay. What about valuation ratios? Price to sales?
Currently around 5.6 times sales. That's, higher than the overall S&P 500 average.
And price to free cash flow, since that's positive now.
About 27.7 times. And that's interesting because earlier reports apparently had it lower, around 16.7 times, which implied a much lower share price, maybe closer to $32.
So the market's paying a higher multiple for that free cash flow now compared to before.
Seems like it. which suggests more optimism about future growth is already baked into the current price.
Given their history and recent profitability, just looking at earnings power value is probably not the best way to value them right now.
Agreed. A discounted cash flow, or DCF, model usually makes more sense for a company like Affirm, focused on growth.
How does that work, basically?
Well, you start with their current free cash flow, that $613 million TTM number. Then you have to project how much that cash flow will grow in the future.
Making assumptions.
Big assumptions, like maybe you guess 25% growth for 3 years, then maybe 15% for 2 years, then a long-term slower rate, say 3 or 4%.
Okay, project future cash. Then what?
Then you need a discount rate, the WACC, weighted average cost of capital. It reflects the riskiness of those future cash flows and Affirm's cost of funding. Reports put it somewhere between maybe 17% and 21%.
That seems high.
It reflects the perceived risk. But let's say, just for discussion, we used a rate like 15%. You take all those future projected cash flows and discount them back to what they're worth today using that rate. The sum is your estimated intrinsic value.
And the result is really sensitive to those growth and discount rate assumptions, right?
Actually sensitive. To get a DCF value significantly above the current $52 price, especially using a discount rate like 15%, you'd need some pretty optimistic, sustained growth assumptions for a long time.
And thinking back to that earlier implied price around $32 based on the lower PFCF multiple.
Yeah, it suggests the current market price is already pricing in quite a bit of good news and future execution.
Okay, so that's the valuation picture. What about who owns the stock? Does that tell us anything?
Ownership structure is always worth a look. For Affirm, Max Levchin holding a significant chunk of stock is definitely notable.
Aligns his interests with shareholders, generally a good thing.
Right. And you can dig into the details in their latest proxy statement, filed April 25th, 2025. It lays out what shareholders are voting on.
Like electing directors.
Yeah.
The usual stuff.
Yeah. Electing directors Class 2 this year. The advisory vote on exec pay, the say on pay, ratifying Deloitte as the auditor. Pretty standard.
Anything else interesting in there?
Yes, actually. They're reproposing 2 things from last year. One is to declassify the board.
Meaning all directors elected annually.
Exactly, instead of staggered terms.
Yeah.
Seen as increasing accountability. The other is removing supermajority voting requirements for certain charter bylaw changes.
Making it easier for shareholders to enact changes if they have a simple majority.
Right. And apparently Affirm has been talking to major shareholders about this. Last year, both proposals got over 99% support of the votes cast.
But they failed.
Yeah, because they needed 2/3 of all outstanding shares, not just those voted, so they didn't hit that threshold. Putting them up again shows they're still pushing for it, likely responding to shareholder feedback.
And they also mentioned focusing executive comp on reducing share dilution.
Yeah, that's usually seen positively by investors, too. Helps protect the value of existing shares.
Okay, so ownership and governance seem relatively aligned with shareholder interests, especially with these proposals. Let's shift to the unavoidable topic, risks.
Absolutely crucial. A SWOT analysis helps frame this. Strengths. Their proprietary underwriting tech using machine learning.
That brand trust from no late fees.
Network effects kicking in, good access to capital markets, the growth in Affirm Card and AdaptAI, lots of positives.
Weaknesses, though. Still that history of unprofitability, even with the recent quarter. And the competition is just fierce, right? Especially for those big merchant deals.
Intense. But then you have opportunities. The whole BNPL market is still growing. They can push into new areas like travel, ticketing, they mentioned growth there, more product innovation, international expansion, Canada, UK, leveraging all that data they have, more partnerships.
But then, the threats? Competition, again, losing Walmart exclusivity was a big reminder.
Huge. Regulatory scrutiny is always hanging out there, even if nothing major has happened federally lately. State-level actions are always possible.
Credit risk, obviously. If the economy tanks, defaults could rise. They need constant access to funding markets.
Macroeconomic stuff, inflation, interest rates, recession fears all impact consumer spending and their own borrowing costs. Merchant concentration risk, cybersecurity.
Yeah, that Evolve Bank incident was a reminder there.
And general interest rate sensitivity. Lots to watch.
We should probably also touch on those U.S. tariffs imposed in 2025. How might that play out for Affirm?
It's indirect, but potentially significant. Tariffs mean higher prices on imported goods.
Which could cut both ways for Affirm, right?
Exactly. On one hand, higher prices might make people more likely to use BNPL to spread out the cost. So potentially more demand.
What?
But higher prices also squeeze household budgets. That could make it harder for people to repay loans, increasing credit risk for a firm. Plus, if tariffs slow the economy overall, that's generally bad for lending.
So for a firm, they finance a lot of those goods that might be tariff affected.
Right, so it hits potential demand and repayment ability. However, they do have mitigating factors. Their underwriting is supposed to be sophisticated. They focus a lot of their 0% offers on higher credit quality consumers. They have diverse products now and strong merchant relationships. It might cushion the blow somewhat.
Okay, so summing up the key risks for an investor. Definitely credit risk, especially in a downturn. Competition, regulation, funding access, proving consistent profitability, the current valuation itself, tech risks, relying on key merchants, cybersecurity, interest rates, and maybe even short interest in the stock.
It's quite a list. So bringing it all together, Affirm clearly has strengths. They're innovative, they've built a trusted brand, their network is growing, and they've shown that encouraging step towards profitability.
But you can't just brush aside the risks. The competition isn't going away. Credit cycles happen. And that valuation, well, from a classic value perspective, it doesn't scream bargain right now. There's not much margin of safety baked in at this price.
Which leads us to our final recommendation based on this analysis. It's a H-D.
Okay, H-D. Why specifically?
Basically, we acknowledge the positive momentum, the market opportunity is real, but the current price seems to already reflect a lot of that optimism. For a value investor, it just doesn't look like a compelling entry point today.
So if you already own it, maybe you hold on and see if they can keep delivering on that profitable growth.
That could be a reasonable approach, yes. But for someone looking to initiate a new position, we'd suggest maybe waiting. Waiting for either a pullback in price to create a better margin of safety, or for more concrete proof that this recent profitability is truly sustainable over time.
Makes sense. Okay, so here's something for you, the listener, to think about after this. We talked about their AI, Adapt AI, looking ahead, say 5 or 10 years. How could that platform fundamentally change the game in consumer lending? Could it personalize things so much that it actually disrupts traditional credit scores as we know them?
That's a really interesting question. The potential is definitely there. And if you enjoyed this deep dive and want more like it,
Please subscribe to the Stock Analytics AI YouTube channel. We'll be doing more of these in-depth analyses.
and just the standard disclaimer. This discussion was for educational purposes. It is definitely not financial advice.
That's right. AI was used in preparing the analysis we talked about, and it's absolutely critical that you do your own thorough research before making any investment decisions.
Hopefully this gave you a lot to think about regarding Affirm.